Every month a system runs against you, perfectly engineered, perfectly legal, and almost nobody inside it says so out loud.
Come on. My bank sends me birthday emails. They have my mortgage, my direct deposit, my whole financial life. You're telling me that same bank is running some kind of operation on me?
Not on you, on your passivity. There's a critical difference, and that difference generates billions. For them, every single quarter.
Billions. From my sad little savings account.
From 4.6 trillion sad little savings accounts collectively earning almost nothing. While the institutions holding that money post record profits. I have a document, internal rate optimization analysis, major retail banking group. They don't use the word exploit. They use deposit cost management. Same mechanism, cleaner language.
Wait, what document? Where did that come from?
We'll get there. But first, you need to see the number at the center of it, because once you see it, the way you look at your account balance will never be the same.
Okay, now I'm actually listening.
Right now, somewhere on your phone, there's a savings balance earning between 0.01% and 0.5% annually.
That's literally everyone I know.
And at that exact same moment, the bank holding that money is lending it back into the economy at 7% to 24%. Mortgages, auto loans, credit cards, personal lines.
Okay, but that's just banking. That's always been the model. Borrow low, lend high.
Correct, but here's the breach. The gap between what they pay you and what they earn on your money hasn't just persisted. It has widened deliberately, systematically, with full regulatory awareness.
Widened how? Like recently?
In the last 3 rate hiking cycles, banks increased loan rates within days of central bank decisions. Savings rates moved weeks later, sometimes months, on some accounts, never.
I felt that personally. My mortgage repriced overnight. My savings account acted like nothing happened.
That lag has a name inside the industry. Deposit Repricing Delay. In that document, it's listed as a strategic lever, not a coincidence, a lever.
So they planned the delay.
They modeled it, tested it, deployed it, knowing most customers would never move.
Because switching is painful.
Because switching feels risky to people psychologically conditioned to trust the institution with the biggest building on the high street. The breach isn't in their boardroom, it's in your assumptions. And that document shows exactly how deep this goes. Let's talk about the engine. What most people think of as a savings account is actually the cheapest fuel a bank can legally acquire.
Cheapest fuel. So we're the gas station now?
You're the crude oil, unrefined, cheap to extract, and they need you to believe you're impossible to replace.
How is this legal? There must be rules.
Rules about risk, capital requirements, liquidity ratios, stress tests, but there is no law. In the US, the UK, most developed markets, mandating a minimum interest rate on a retail savings account.
So they can legally pay me nothing?
Technically, yes. The market is supposed to generate competition. Competition is supposed to drive rates up. That's the theory.
And the reality?
Deposit concentration. The top 5 US banks hold over 40% of all retail deposits. Top 4 in the UK. Similar picture. When that much money sits that concentrated, competition softens. Rates don't need to be attractive. They just need to not be embarrassing.
An oligopoly dressed as a free market.
Dressed very well. Mobile apps, reward programs, cashback friction, enough surface level noise to simulate value.
And underneath all of it,
the spread, net interest margin, the single metric every bank CEO is judged on. The gap between what they pay depositors and what they charge borrowers. In 2023, major U.S. retail banks reported net interest margins exceeding 3.5%. Average consumer savings rate below print.
They're skimming 3% off every dollar I park with them.
Minimum. Commercial lending pushes that spread even further.
Why didn't anyone tell us this? Where was this in school?
It's disclosed, buried in quarterly earnings reports, celebrated on investor calls. The language is strong net interest income growth. Translation: cheaper deposits held longer, loans repriced faster.
That's actually insane. It's public information and nobody talks about it.
Because it's framed as financial health. Strong banks, stable system, what's good for the bank gets presented as good for the economy.
Even when the depositor is being systematically hollowed out.
especially then. And here's the layer most people never reach, that when banks need capital beyond retail deposits, they access interbank markets, central bank facilities, institutional investors. Rates there are negotiated, efficient, transparent.
So they have premium options. We're just the cheapest option.
The most convenient, cheap option. And that internal document, it models exactly how rate-sensitive each customer segment is. Who will leave for a better rate? Who will stay regardless?
They score us.
They segment us. And the segment that stays regardless of rate, that is the single most profitable segment in the entire retail banking model.
And most people have no idea they've been sorted into a category.
Most people are still proud of their savings balance, which is exactly where the mechanism needs them to be. Now we get to the glitch. This is where the data stops being abstract and becomes personal.
Good. Because so far, I can see the system, but I can't touch it. What's the actual crack?
The crack is rate asymmetry at scale, and it has a measurable dollar value attached to every household sitting in a legacy savings account right now.
Give me the number.
2023. The Federal Reserve raised rates to a 22-year high. Federal funds rate 5.25% to 5.5%. At that exact moment, the national average savings rate at major U.S. retail banks sat at 4.46%.
The benchmark rate was over 5%. Banks were paying depositors less than 0.5%.
On standard accounts, correct. And here's where the glitch becomes undeniable. That same period, money market funds investing in essentially identical short-term instruments were yielding between 4.5% and 5.2%.
Accessible to regular people?
Through any brokerage account, Fidelity, Schwab, Vanguard. Minimums as low as $1 on some platforms.
So the glitch is, the alternative existed, right there. And most people had zero idea.
Zero idea. And here's the scale of that. American households held approximately $4.6 trillion in low-yield savings and checking accounts, while high-yield alternatives sat largely untouched by the mass market.
4.6 trillion.
Earning under 0.5% against a backdrop where they could have been earning 10 times that.
That's not a glitch. That's a catastrophe.
In 2023 alone, Americans lost over $600 billion in interest.
$600 billion left on the table by ordinary people.
In a single year.
Okay, stop. I need to push back because this is sounding too clean.
Push back then.
If this was so obvious, 5% sitting in money markets, people earning 0.5%, why weren't financial journalists screaming about it every day? Why weren't executives hauled before Congress?
Some were, there were hearings, there were op-eds.
But nothing changed.
Nothing structurally.
Because it's not illegal.
Because it's not illegal and because
people still didn't move their money even after being told.
Exactly.
Which means the behavioral trap is stronger than information itself.
That is the glitch, right there, what you just said.
The information existed. The alternative existed. The system still won.
The system isn't built on secrecy alone, it's built on friction, inertia, and the psychological weight of perceived safety. Knowing the gap exists is not enough to make most people act. The banks modeled this. They knew disclosure wouldn't trigger mass migration.
Because switching feels like risk, even when staying is the actual risk.
And that asymmetry between the fear of action and the invisibility of inaction, that is the most profitable glitch in modern retail banking.
So the $600 billion isn't just lost money. It's a behavioral tax.
Paid voluntarily, every single year, by people who genuinely believe they are being financially responsible.
That's the part that makes me angry. These aren't reckless people. These are people doing exactly what they were told to do.
Saving, being patient, trusting the institution, getting systematically under-rewarded for all three.
So who actually knows about this? Who is sitting at the top of this system, watching $600 billion flow in the wrong direction and saying nothing?
That is exactly where this goes, because the people who know and act on it don't look anything like you'd expect. The people who know are not hiding. They are publishing quarterly in earnings reports that receive standing ovations on Wall Street, while the depositors fund in those earnings check their balance and feel responsible.
It's in plain sight.
JP Morgan, Bank of America, Barclays, NatWest. Their 2023 annual reports, net interest income growth cited as a key driver of record profitability.
Record profitability. While inflation was eating everyone alive.
2022 to 2024, the highest inflation environment in 4 decades. Energy bills doubling, groceries up 20%, real wages negative for most of that window.
And banks posted record profits.
Combined net interest income for the 5 largest U.S. banks in 2023 exceeded $250 billion.
That number should be front page, every single day.
It was reported, celebrated, actually markets rallied on those earnings calls.
Here's where I confront you directly. You've shown me the mechanism, the scale, but you keep framing this like it's permanent, like it's architecture we can't touch.
I'm framing it accurately.
No, you're framing it as fixed. I don't accept that.
I didn't say fixed, I said structural.
What's the difference?
Structure means it persists without active intervention. Fixed means it cannot move. It can move, not through outrage, not through one person switching accounts.
Then what moves it?
Scale, regulation, or enough rate-sensitive depositors migrating simultaneously to force competitive repricing.
Has that ever happened?
2023, partially. When money market awareness spiked, Silicon Valley Bank collapse, media coverage of yield gaps. Deposit outflows accelerated enough that some institutions quietly raised their savings rates.
So awareness worked.
Awareness of alternatives worked, briefly. Then inertia reset.
In the UK, it's worse, isn't it?
Structurally more concentrated. 4 banks, Lloyds, Barclays, HSBC, NatWest, dominate retail deposits to a degree that makes the U.S. market look competitive by comparison.
And the FCA?
Launched a savings review in 2023, called out the repricing lag directly.
And?
Some banks moved modestly. The structural incentive to underpay depositors did not disappear. Regulatory pressure created a temporary correction, not a reset.
Regulation bends it, doesn't break it.
The system absorbs regulatory friction without fundamentally repricing deposits. It's optimized for exactly that.
That's bleak.
That's architecture.
So what? We just accept it?
Accepting it and understanding it are completely different positions. One costs you money. The other gives you options.
Stop describing the cage. Tell me where the door is.
The door has always been there. Most people never looked for it because they didn't know they were inside.
Then show me. Right now. Because millions of people on both sides of the Atlantic are sitting in accounts quietly draining their own future.
And the protocol to stop that? It's simpler than the system needs you to believe. 3 steps, no theory, no complexity, just the exact protocol that rate-sensitive depositors, the ones banks actually fear losing, already run quietly.
Finally, let's hear it.
Step 1, immediately separate your emergency fund from your growth savings. Your emergency buffer, 3 to 6 months of expenses, moves into a high-yield savings account. Not your legacy bank, an online bank or credit union running a nationally competitive rate. In the current environment, anything below 4% annually is a liquidity rug pull on your own future.
So the first move is just relocate the cash, already sitting there doing nothing.
Without closing anything, without touching your direct deposit, a parallel account, 20 minutes, 0 cost on a $20,000 emergency fund. The difference between 0.5% and 4.5% is $800 a year, every year. Compounding forward.
$800 for 20 minutes of admin. That is the most expensive procrastination most people don't even know they're running.
Step 2, automate a fixed monthly transfer into a brokerage account holding a single broad market index fund or short-term treasury ETF, depending on your timeline. Not stock picking, not timing, a standing order. Same date every month. Removes emotion, kills the temptation to wait for a perfect entry.
Because the perfect entry never comes.
The right moment is the moment you start. Time in market statistically outperforms timing the market across every 20-year window in modern financial history. No exceptions.
Step 3.
Stop treating your bank like a relationship. It is a utility. You review your energy provider, your phone contract, your insurance. Review your deposit rate annually. If your bank sits more than 1 percentage point below the national high yield average, you negotiate or you execute a liquidity migration.
Banks are just another subscription we forgot to cancel.
The most expensive forgotten subscription most households carry.
So the whole thing distilled. The systemic extraction is real, the yield gap is real, but the exit is also real. And it costs nothing except the decision to stop being passive capital.
The banks are not the villain of this story. Passivity is.
And once you stop being passive,
you stop being cheap funding. You become a cost they have to compete for. That is the entire shift.
That's everything.
There is one more file. It goes deeper than savings accounts. It goes into the exact mechanism banks use to profit from your debt, while engineering you to believe that debt is your fault. That file we open next time.
I'll be here, and after what I just heard, so will everyone watching.